Hello, everyone. This is Jack Bosch speaking, and welcome to the Forever Cash Life Real Estate Podcast. I have a special guest today. We have Brett Swarts here, and he's going to talk about a concept that's called the Deferred Sales Trust, which allows you to time the sale of a property with capital gains perfectly and take advantage of all kinds of different rules. So he's going to talk about that. It's something I personally actually had never heard prior to this call and prior to preparing for this call and prior to getting to know Brett. So I'm super excited about it because it opens some I don't know if new, but some very little known loopholes and opportunities to save taxes. So we'll get started in just a second, right after this.
Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
All right, so here we are again. Well, first of all, welcome, Brett. How are you doing?
Great, Jack. Thanks for having me.
Wonderful. I'm super excited to have you here. So let's jump right in. Tell us, you're going to talk about, or we're going to talk about Deferred Sales Trust. Now, what the heck is that?
Yeah, so most commercial real estate owners or business owners or high-end primary homeowners, they struggle with capital gains tax, somewhere between 30 and 50% of their gain when they go to sell their properties or their assets. We use a Deferred Sales Trust, which is just a manufactured installment sale, to give tax deferral, liquidity, diversification. And the best part probably for your listeners that they're going to be most excited about is the ability to buy commercial real estate at optimal timing, therefore eliminating the need for the 1031 exchange so that they can create and preserve more wealth.
All right, so that all sounds really great, but I don't have a clue how that really works. And what does optimizing the time of the sale or the purchase mean or the sale mean? Just start us from A and explain to us, how did you even come up with that? What's the challenges people are facing? Just go start at the beginning because our audience is a combination of, we have some really experienced people in there. We have some really beginners in here. So we want to make sure we cover something for everyone.
Absolutely. Yes, Jack. So let's start with what's going on in the current demographics and the current economy. Okay, so big picture, and then we'll get into the micro aspect of how this all works. So according to the American Bankers Association, there's about $17 to $20 trillion that will pass from one generation to the next in the next 20 years. Okay. And this is known as the largest wealth transfer in the history of the world. And this generation is known as the baby boomers. Okay. In fact, there's 77 million baby boomers in the U.S. alone. And every day, 10,000 baby boomers turn 65. And what are they faced with? They're faced with highly appreciated assets, whether it be commercial real estate, primary home, or a business, to name a few. In fact, those three categories represent 50% of the total net worth in all of America. Okay. And they're struggling with, how do I pass it from one generation to the next? How do I retire from the toilets, trash, and liability? How do I sell my business and be done with the employees and all the laws and all the different things that I have to deal with? How do I, in a sense, get freedom from capital gains taxes? And the capital gains tax, again, is 30 to 50%. It's the largest expense probably on their number one biggest deal they'll ever do in their lifetime. And they don't have a good solution. Most of them don't have a 1031 exchange. In fact, a 1031 only works for investment property at this point, practically speaking. Right. It's been narrowed down, and it doesn't work for a primary home. It doesn't work for a business, and so they feel trapped. They feel trapped. They want time. They want liquidity. They want to be able to pay off debt. And the Deferred Sales Trust solves all of those issues and gives them back a lot of what they want, a passive income stream into commercial real estate and or stocks, bonds, and mutual funds of their choosing. And it takes the risk, a lot of the risk off the table versus staying in a highly appreciated asset with debt and or going from a 1031 exchange to the next 1031 and overpaying for property. So I'm going to pause there because you might have some questions.
No, so far I'm following you. So basically what you're saying, and to simplify this even more, is basically the baby boomers sitting on assets. They need to or want to sell those assets, but if they do, they end up paying a bunch of taxes. And you have a strategy that allows them to either reduce those taxes or delay those taxes or eliminate those taxes. Which of the three is it?
Yes, exactly. And those still two deal stories that just closed. Okay, one of them was on Thursday, just last week. It was a really, really nice lady. She lived in Cupertino. That's just right next to the headquarters of Apple. And she sold her high-end primary home. She had been there for 20 plus years. She bought it very low, and she sold it for about $3 million. And so she was faced with a capital gains tax above and beyond her exclusion, right, which is the 121 exclusion. If you live in a house the last 5 years, you have $250 excluded or $500 if you're married. $250 if you're single. So she was faced with $400,000 above and beyond her exclusion. So she used the Deferred Sales Trust to sell her house and get a passive income stream. Part of the challenge is when you live in a highly appreciated home and you feel trapped is a lot of these folks, it's hard to afford to even rent down the street if they're on a fixed income, and they feel real estate rich and cash flow poor. So we're able to trade an illiquid asset that, her kids are gone and it's highly appreciated for a passive income stream. It can also be an active income stream. She can partner with the trust and go buy more apartment complexes. She owns some apartment complexes too. But the point is she wanted to retire from that. The second one is a gentleman, his name's Peter, and he lived in Marin, California, and he was driving 2.5 hours fighting traffic to South Sacramento to manage his 18-unit apartment complex. And he's done 1031 exchanges for years and years and years and years. But he goes, Brett, I'm close to 70 now. I have 18 problems now. I don't want 36 problems. I want to retire from this. I've made my wealth. I want to pay off my debt, but I don't want to overpay in a highly appreciated marketplace via a 1031 exchange and get in the same position I was in 2007 before the marketplace shifted. So the 1031 exchange is a good, viable tax deferral option. However, it has some limitations. The first one has to do with the 180 days to close and the 45 days to identify. This creates a place where the timing is very, very restrictive. Therefore, oftentimes we end up overpaying. We call this the sell high, buy higher 180 days later. And we use an analogy of the candle burning at both ends, Jack. And so imagine this is your candle. This represents your return. But as the candle burns, your return gets smaller and smaller. Well, what's burning the candle right now? Well, first thing is cap rates are going lower. And inventory is lower, right? Which means prices are higher. That's not good. The other side, although interest rates have gone down a little bit here in the past month, interest rates are, generally speaking, over the last few years have gone higher. And so as this candle burns, your return represents smaller and smaller. And unfortunately, the 1031 exchange, because of the equal and greater value rules and the timing restrictions, tends to put a position for a lot of these clients where they're overpaying for properties that they otherwise wouldn't have purchased if it wasn't for the capital gains tax. I'm going to pause there because you might have some questions.
So again, so let me simplify this a little bit. So in essence, I'm still not really at the bottom of it, but we still have some time here. That is in essence, so there's somebody, and by the way, it doesn't have to be a baby boomer. It can be somebody 35
Correct.
years old.
Yeah.
So it can be done with your investment property or with your personal property, right? So in essence, what they're doing is they're selling the asset. And so far, if they don't use your strategy, if you sell your asset, let's say you buy it for $1 million in the Bay Area, you get a little shack for that in the Bay Area. Or even if you buy it in Phoenix, Arizona, you buy a house a few years ago for $100,000, now it's worth $300,000 or $500,000, whatever the number is. You buy it for $200,000, now it's worth $500,000. You sell it, you have $300,000 that you have to pay taxes on if it wasn't your primary residence.
Correct.
Right? And if it was your primary residence, then it's not an issue at those numbers. But if it wasn't your primary residence, if it was your primary residence and you have now $1 million in equity, you still have the same issue. So you have all this extra, you have exceptions and stuff, but then you have to pay on the top, you have to pay taxes, capital gains taxes. Now, they are whatever they are, and I understand they used to be 15 or 20%. Now, after Trump, they can be lower, they can be high. It depends on all kinds of different tax kind of strategies in the background. But so now you have a strategy that allows them to turn that into cash flow and so on. But we haven't fully understood, you haven't really explained to us why yet. What do they do with the money? Once they sold their property, and I understand how 1031 exchange works, and it makes sense that you said, just for the listeners, if they don't know how 1031 exchange works, it's a tool that I've used plenty of times in the past. For example, I bought some houses here in Phoenix, some rental houses that did horrible in cash flow because they're kind of in the wrong area of town. I bought some rental properties that every year we had a skip or a midnight move out or they trashed the property. So they destroyed my cash flow every year. And I had to put the money that I made in cash flow right back in the property to fix it up, got the next tenant. So I never made cash flow on these properties, but they appreciated dramatically in value. So I took 3 of them that I had bought for $40,000 a piece, and they had now sold for $120 or $130, and I basically made $100,000 on each investment properties, and basically took those $350,000 at the end of the day and moved that into a different market and bought $400,000 or $500,000 worth of assets with that real estate again. And because I did that, I identified the new properties in 45 days, and I closed on them in 180 days. I was able to do that with a 1031 exchange. That means the taxes that I would have had to pay on this $200,000 gain, I didn't have to pay. They're deferred. That's being done in the real estate industry by those who are in the real estate industry all the time. But the problem that you had mentioned, I fully get it, is that in the current market conditions, particularly if you want to go into prices of houses are high, prices of apartments are high, interest rates are up. So basically, if you have to do a 1031 exchange, you have to replace your old property with something that just produces less percentage of cash, because the interest rate is higher, the prices are higher, so it produces less. So so what you're saying is basically you have a solution for that. So now let's really cut into it. If somebody sells their asset, whatever that is, their primary residence or their house, and they have $1 million sitting there, let's take an easy example of $1 million that they otherwise would have had to pay taxes on. What do they do? What's your solution?
Right. So they put the money into the trust. Okay. And where's that? Well, it's the funds are held at a bank, and the bank can invest in stocks, bonds, mutual funds, back into commercial real estate syndication deals, back into a new business startup, back into developing real estate. So you basically get a lot more flexibility, and you also don't have to take on any debt, because it's not a 1031. We're not having to replace each refrigerator, or again, buy. Our parents taught us to sell high and buy low. But unfortunately, the 1031, you sell high, and oftentimes you buy higher 180 days later. So that's not good. The second thing has to do with the new depreciation schedule. Okay. So depreciation schedule travels with the 1031. The Deferred Sales Trust, you get a brand new depreciation schedule. But let's walk through a practical thing. $1 million sitting there, and it's invested. Most of our notes earn 8%, and after fees pay about 6.5%. But the key is it's in safe, conservative allocations over any given 10-year period of time, of which at that point you can renew for another 10 years and renew for another 10 years and pass to your kids. But in the meantime, you might find a deal, Jack, tomorrow. You may find a deal on day 181. You may want to just wait for this market to shift and wait a year or two for that $1 million property that you would have bought, but now it's worth $850,000. And in the meantime, your cash was on the sidelines, and you waited for those values to drop. And you form a brand new LLC, Jack, and you partner with your trust, and you buy that property all tax deferred. And because you partnered with your trust, it's in a tax deferral state.
Okay, so the trust. So I'm taking $1 million and I'm putting in a trust.
Yes.
How is that? Why is that then not subject to taxes? Do trusts
because you carried back. Let's talk about how this works, Jack. Okay, so let's just put the trust to aside for a second. I want to explain to you IRC 453, which is the tax law this is based on, which is a 90-year-old tax law. If anyone ever comes to you with a new tax strategy, you should ask them, well, what's the tax law it's based on? Well, ours is based upon IRC 453 versus IRC 1031, right? These are different sections of the tax code. They're legal loopholes, okay? IRC 453 is also known as seller carryback. So, Jack, let's just use a $1 million deal. I come to you and say, Jack, I want to buy your $1 million property. Imagine you owned it free and clear, but imagine you had a $400,000 liability if you didn't do anything. So you definitely want to do some kind of tax deferral. But if I come to you, Jack, and say, Jack, I'm going to give you a $300,000 down payment, would you carry a note for $700,000? And you say, sure. And that scenario, Jack, if I gave you $300,000, how much actual receipt did you receive?
$300,000.
You got it. So you're going to pay tax on that $300,000. Now that $700,000 is in a deferral state. You're carrying back, right? It's not triggered. It's owed, but it's not triggered until and if I pay you back that $700,000. Correct?
Right.
Yeah. So another scenario. I say, Jack, I'm going to give you a 0 down payment. And hypothetically, if I gave you a 0 down payment, Jack, and you carried a note for $1 million, how much tax is triggered today if you receive 0?
In this case, 0.
Zero. And the other million's in a deferral state. So that is the foundation of IRC 453, which is just a seller carryback, seller financing, okay? So let's enter in the deferred sales trust. What happens? Well, you have this $1 million buyer all ready to go, Jack, right here, and you're about to sell it. But instead of taking the million directly from that buyer and owing the tax, the trust is going to jump in right in between. And the trust is actually going to give you a note for $1 million, and it's going to give you a 0 down payment. And it's going to turn around immediately, and it's going to sell it to that cash buyer. He can have a loan too, doesn't matter. But the point is, he's going to put $1 million into the trust. Now follow me here, Jack. If the trust bought it for $1 million and sold it for $1 million, how much gain does the trust have?
0.
So how much tax does it owe?
Therefore 0.
Jack, if you received a 0 down payment and you carried back the full amount of $1 million, how much tax is due today for you?
Also 0.
You got it. So that's how it works. The buyer goes away. He's gone. He takes title the same way he would have. And now the funds are sitting in the trust, tax deferred, no debt, just the proceeds. So I'm going to pause there, see if you have any questions.
So now I'm starting to get this. So this is actually very cool because obviously we are also doing lots of seller financing on our land. So as you guys know, with the landprofitgenerator.com strategy, which is our core flagship home study course program, and everything we teach is around the land profit generator. Currently we sell about 80% of all our properties that we sell with seller financing. These are like cheaper pieces of land in the range of $10,000 to $100,000. Therefore, though, I can vouch for what you're saying is correct. That because I even have a segment in our seminar where in our seminar where I talk about the tax ramification of selling with seller financing, and with seller financing that in land there's a loophole that you're not classified as a dealer, and therefore you can use the seller financing tax strategy. If you are a dealer, I think there's a little bit of a problem with that strategy, but still, luckily we're not dealers, so therefore this works. And the average person out there that buys a property, holds it for a bunch, and that is also not a dealer. So that works. So we know that if somebody gives us $1 down payment, well, then we pay taxes on that dollar minus subtracting any ordinary business expenses, which then means we're really not paying taxes. So that point makes sense. So now you're putting the trust in the middle. So you're selling it to the trust on a note, and the trust sells it for cash to the next person. So therefore, the property now is gone. The trust has $1 million, and the $1 million is being owed to you in monthly payments, but with or without interest.
Precisely. So yes, there's an interest rate. And by the way, great job. You got it really quick, Jack. And so you've done a lot of deals, so I can tell your mind works well on this. So yes, the interest rates are typically 8%, depending on the risk tolerance. But your risk tolerance may be ultra conservative, which means maybe 5%. So there's an interest rate assigned to the note based upon your risk tolerance. What's the risk tolerance? It's a questionnaire. You answer about 15, 20 questions, and that determines how and where the funds are invested. And then the financial advisor, which you can use your own, or you can use one of our strategic partners. We have thousands of financial advisors across the U.S., and that they come with an allocation, and they say, Jack, here's the allocation. What do you think? Yep. Before anything moves, you sign off on that, which is also another thing. The funds don't move without your signature. Okay. Now, most of our notes earn 8. It's a moderate over any 10-year given period of time. Earn 8 after fees, pay 6.5. Although the structure of the note is to pay you 8 net of fees. We can't promise that. Depends on how things get invested. But at the end of 10 years, the goal is to give you 8. Okay. Now you can renew that for another 10. Renew that for another 10. And this kind of goes into the why you asked a little bit earlier in the conversation. The why is, as soon as you pay the tax, you lose. We define winning as tax deferral. We define losing as paying the tax. Why? Because once you pay the tax, it's gone forever, right? But if you can keep it in your family, keep it in your community, and so you can earn and create and preserve more wealth, you can give more, save more, and actually spur the economy. This is why they have these legal loopholes, so people don't sell and put all their money under their mattress. They want to keep these things going so that it spurs economic growth. So you follow me so far? Any questions there?
I'm following you. So in essence, what you do with your typical customer who does that is, let's say they take the $1 million. They now have $1 million now in the trust. you manage the trust, and your team of trusted advisors invest that money for them in different kind of equities, either stock market or bonds and funds, or not really bonds, they wouldn't produce 8%, but then in different kind of things in other businesses or in real estate. And because there's no 1031 exchange involved, you're not limited into what can you invest in, because the 1031, again, you have to invest into something like kind. So if you go from real estate, you can't just invest in horses all of a sudden, right? So this is not like kind. But plus, horse investing is probably not allowed by 1031 exchange rules. I don't know exactly, but here there's no 1031 exchange. You just sold it to a trust that you happen to own, where you're the beneficiary of, right?
You're actually the creditor, okay? And by definition, you can't
right?
be the beneficiary or the owner of the trust there, because then you would take constructive receipt. So everything you said was correct, but I want to clarify a couple things. The financial advisor can't be the trustee. My role is the trustee. By the way, I can't move the funds. The funds only move with your signature. It's all protected, okay? The funds are never commingled to other accounts. But the key is the financial advisor and the trustee can't be the same person. They need to be separate. We call it, and then also the law firm who set this up, they're also separate from each one of them. So we call it kind of the balance of powers. Everyone's kind of has to sign for anything to move, but ultimately you're the creditor, you're the lender, right? And you have certain rights and protections that every lender has that would say, you know, the funds can't move unless you, the lender, sign off on it. So,
Right.
So yes, and in the meantime, you invest in whatever's available. But what I like best is you invest in commercial real estate deals. Okay, and you find cash flow deals or land opportunities. That's fine too, and up to 80% of the funds. So a little caveat: if he has $1 million in there, 80% can go to illiquid assets such as commercial real estate or land development deals. The other 20% would stay with liquid investment grade securities. So these are some of the largest companies in the world. And why? Because it's like a reserve account. We don't want to put too much stress on any one deal. Now, we've done thousands of closes. And if anyone ever comes to you with a new tax strategy like this, you should ask a number of questions. The first one is, how many have you closed? Thousands of closes. How long have you been doing it? 23 years. How many people have joined you? Thousands of business professionals. But the biggest one is, how many IRS audits have you actually survived? And are there any current IRS audits going on? Our answer is 14. 14 no-change IRS audits, including 2 of them which were formal audits. And one of the biggest ones was a $125 million Southern California property that was audited. So, and all of those were no-change audits, not one single issue. So it's 100% legal. We've had 0 issues with the IRS. And that's key, because we want to make sure that your listeners know that we're not just saying, try this out and see if it works. No, we've already blazed the trail. It absolutely works. But it does take a team of professional advisors. Like I said, the tax attorneys, the financial advisor, the trustee, everyone working together to make sure that we execute, because there's definitely rules we need to follow.
Right, that makes sense. So that's good to know. So thank you very much for letting us know that this has been existing for a while and it's been used for a while. And now, with that all said, if you're the trustee, I'm sure there's fees for that too, right? So what is like the typical fee structure on a deal like that?
Yeah, how do we get paid? Yeah, generally speaking, there's 3 sets of fees. The first set is to the tax attorneys. It's 1.5% on the first $1 million. It's a one-time fee. And so if it was $1 million deal, it'd be $15,000. Anything above that would be an additional 1.25 on that additional amount. And that includes the legal and tax structure, and also audit defense for the life of the trust, which is very important. You want to make sure whatever tax strategy you're using, that the attorneys stand behind their work, and the attorneys do on this one. The second set of fees to the trustee, and that happens at close of escrow, and then plus once a year thereafter, based upon the net value of the trust. And that's about 50 basis points. Okay, so it's 1/2 of 1%.
Okay.
The next fee is to the financial advisor, and for him managing the funds. That's generally about 1 point, about 1%. Just depends on the size of the deal, and depends on how and where the funds are invested. Now, if you say, well, I like commercial real estate and I'm probably not going to be with the financial advisor, that's fine. Well, 20%, remember, needs to stay with the financial advisor. The other 80% can go out to commercial real estate deals or a new business venture too, as long as it's investment purposes. So he's no longer managing those funds. So what happens is that fee goes away for the financial advisor, but the trustee fee does double to 1. So remember in the beginning I said earn about 8, net about 6.5.
Right.
So that's how we work out those ratios. However, here's the key. When you go to buy that deal, Jack, outside, the structure is an 80-20 split, meaning 80% to Jack and 20% to the trust, even though the trust puts up 100% of the down payment.
Mm-hmm.
Okay. Now the trust, remember, it needs to pay you, so it needs to get that 8%. So it has a preferred return of 8, but after that, 80% goes to Jack personally, and the other 20 rolls into the trust. So you just bought a deal on an 80-20 split with 0 down for yourself, although the trust is owed you the money, has partnered with you, and this is how we get a brand new depreciation schedule.
So let me quickly translate that and summarize it, because there's a lot of stuff in that few sentences right now. So what you're saying is that, so now we have the trust that has the $1 million in there as an example. And of course, again, just for clarification, it doesn't have to be $1 million. We're just using this for mathematical calculation right now. Trust has $1 million, and you're now going, and the trust's $1 million, that is no taxes due, right? Because the trust sold it for $1 million, but also you bought it, you sold it to the trust for $1 million, so there's no profit there. The trust sits there, and it sits on $1 million, and you now, with the trustee, with you, we decide, let's go buy this, whatever it is, this $3 million commercial property, right? So the trust puts up the $1 million, take a $2 million loan, the commercial property spits out $200,000 a year in income. Let's just pick a number, or $300,000 a year in income. Let's say pick $300,000 a year in income. You pay $100,000 to the mortgage. You pay, now you have $200,000 left over. Let's just pick a weird number here, right? $200,000 left over. What you're saying is basically of that, the trust now gets an 8% return on its $1 million.
Preferred return.
80%, $80,000. So there's $120,000 left over. And of the $120,000, 80% goes to me, and 20% goes again into the trust.
Back to the trust, which is then going to pay you out, of which you're going to receive income off the trust and pay ordinary income tax on that. Or let the trust compound. Let the funds compound, because you may not want or need those funds right now.
Right.
And then when you go to sell it, same thing. Pay back the trust the original $1 million that it put in. Although remember, it can only do 80%, so $800,000 would be the down payment there.
True. Yes, correct.
Yeah, instead of the full $1 million, because we had to keep 20% in with liquid diversified securities.
I got that. Yes.
Yeah, and so, but the original amount goes back into the trust plus the preferred return plus 20% of the upside, but the other 80 is with you, Jack, of which you could say, well, how about we roll that into the trust too? And that's fine. And you have the same trust and multiple notes. So this would be the second note, of which let's just say you have 1.5 million now. Now you do the same thing. Up to 80% can go out. And this is where we say we eliminate the need for the 1031. And the idea is to add value, ride the wave up in the highly appreciated market, sell, pay off the debt, move the funds into the trust, protect, preserve, wait, find a deal, great. Maybe a smaller deal, great. Maybe a big deal, great. But wait for optimal timing, right? I mean, that's the key here. As commercial real estate owners, we know when it's a buyer's market and when it's a seller's market. And given enough time, we can find deals. But if you just take off that pressure of the timing, you can make better decisions and hopefully create and preserve more wealth.
Right, and that's why it's worked. That's why it works with both residential properties and the commercial properties, because somebody right now decides, oh, the market is at that height. They go sell their property, make $500,000, $600,000 profit, and they're single. Let's say they take the $250,000 exception. They're still having a $350,000 extra money sitting in there. You don't have to, well, in this case, they would have to pay taxes on that. They do the strategy. They don't pay any taxes. It still makes sense after the fees, probably. It would have to pencil it out, but probably makes sense. And then they're just like, now that money is being invested in conservative ways, that it spits out some cash flow. In the meantime, they'll rent, perhaps just enough to pay their rent, while they're waiting for an adjustment to happen, or while they move to a different market, while they move to a different city. And then when they're ready, they can buy then again and have the trust basically put the down payment on their next new house.
Yes, or even better, Jack, they're tired of managing it themselves. They're tired of the ups and downs and having all the liability on themselves and taking all the risk and all the debt on themselves. And they say, you know what? I want to put the $1 million there, and I'm going to invest some with Jack in some of the land deals. A couple $100,000 over there. I might do another couple $100,000 on a multifamily syndication, another couple $100,000 in a mobile home park. And they're diversifying their commercial real estate equity across multiple operators, right, and multiple geographical locations with different income streams, right? So this is the key and the value of diversification. It's not just stocks, bonds, and mutual funds. That's a small portion of it. But the other part could be multiple, where the 1031 doesn't allow this, right? 1031, basically, you're trading one property for one other property, generally speaking, one product type for one other product type. And remember, equal or greater value, you're having to take on all the debt. I mean, it's just not very flexible. So we're accomplishing the same thing of tax deferral. We're just giving so many more options with no debt, and then also liquidity. Some of the folks just say, you know what? I want at any point to be able to access $100,000 or $200,000, pay the tax on it. Great. I don't have to sell anything or refinance. They may need or want the liquidity, and nothing else offers that as well.
Right. Very cool. I think we got it. We got it. We understand it. If you haven't understood it, watching this, then rewind and listen to it again. Because I think between the combination of the two of us, we explained this, I think, pretty down to earth, such that everyone can ultimately get it. Bottom line is, if I repeat it one more time, is there's a vehicle that allows you to sell your properties anytime, not pay the capital gains tax in that moment, instead be able to invest that money into something else that produces more cash, have access to it. And if you wanted to solve the trust and just end up paying the taxes at any time you can, that is not under the limitations of 1031 exchange, but instead you can move it into different points at that point, into different kind of asset classes at your will, really. And within the parameters of what you mentioned, that 20% needs to be liquid and so on, which makes sense. Then this is a really interesting subject. Now, if you only have like one house that's worth $75,000, it's probably not for you. But if you're dealing with some more complex strategies and some more assets that, like for example, we're thinking about selling one of our apartment complexes very soon, and we'll probably have about $1.5 million to $2 million to distribute between our investors and us. And now
let's walk through that, Jack, just so you know.
Yeah.
So most syndicators like yourself, operators, they don't allow 1031 money, and they don't 1031. They just say, everyone bring us the new money. Let's all buy it together. And then let's sell, everyone pay their tax. And then everyone, let's go on to the next one together. So this is where the Deferred Sales Trust is amazing, in that not only for your own carried interest, right? You probably have carried interest in the deal, which you can defer using the Deferred Sales Trust, but also each of the investors could have, if they wanted to, their own Deferred Sales Trust. So let's imagine there's 10 investors and 5 say, I just want the cash. No problem. They're going to pay the tax. The other 5 say, no, I want a Deferred Sales Trust. Each one can have their own individual Deferred Sales Trust with their own separate financial advisor, with their own risk tolerance. And here's the best part for you, Jack, because they have more money now and they're not paying the 30 to 50%. Oh, guess what? They have more money to invest with you on your next deal. So as a syndicator, it's a way to attract high net worth individuals, but also it's a way to show a greater return for when you exit the deals, because you're helping them with 30 to 50% on every single deal.
Right. Very interesting. So I will definitely look into that more. We're still a few months away from selling those properties. We haven't even put them on the market yet, but our properties are across the board now at 90. Actually, the properties that I manage are at 96 and 99% occupancy, and really, really strong financials. So we are looking at potentially selling them not too far into the future, at least one of them. So we will definitely run the numbers and pencil those in. Now, how does somebody find out more about you, and how do they get in contact with you?
Yes, capitalgainstaxsolutions.com is the first place, and then you can search for me on YouTube. I'm launching a podcast called Capital Gains Tax Solutions with Brett Swarts. It'll be here and here in the next 30 days, so you can listen there as well. We have free webinars. By the way, we don't charge anything unless and if the client does the deal. So we will educate, we will provide, modeling, financial modeling for what you're doing. And another key thing here too. So if the deal is $500,000 and below, it's too small, right? So we found for the fees, for every $100,000 in liability deferred, you need about $500,000 of proceeds. Our average deal is about 2.6 million, and we're deferring somewhere between $300,000 to $400,000, $500,000. Okay, so yeah, for the really small ones. Now, if you have 10 different houses, and this is we come across this, someone has 10 or 12 different houses, and they're all within the $150,000 to $200,000 range. Then you can slowly sell each of those properties one at a time. And ideally, you're selling it to a primary homeowner, right? You're not selling to an investor. And now, because think about this, a 1031 exchange, Jack, what the challenge is with multiple houses everywhere, if you're going to do a 1031, you're probably going to want to sell them all at the same time, which means you're going to have to discount it for an investor and then trade into a 1031. Whereas ours, you could just sell one at a time, hopefully to primary homeowners, and therefore get maybe a 20% increase, and then just compile the money. So if you have multiple deals where it's a greater than $500,000 and greater than $100,000 in liability, then yes. But if it's just a one-off deal that's that small, our fees are going to eat up the savings, and it's not worth it.
Right. But if you had to somebody add, and we probably have a lot of listeners that build up a portfolio of houses, you still have one trust, and then you just sell one house at a time and just get the money into that one trust. Exactly.
And then it kind of compiles all in there, right? And you have multiple notes on different time frames based upon when you did it, right? And then the money just keeps piling. And hopefully, let's say you had 10 homes all with $100,000 in equity. Well, now you have your $1 million there. Well, great. Now let's use that $800,000 to go buy that $3 million deal. So you're scaling up as you're deferring the tax. So that's the idea, to give you more flexibility, more options.
Okay, wonderful. Awesome. Thank you very much. This was very, very educational. It was something that I have to admit that I had not heard about. And I can't believe I hadn't heard about it. It's very, very interesting, very, very cool. Definitely will look into that, because every example that you just covered is an example that applies to us right now, because we got the house that we're selling, and there's enough equity in there. We are having a bunch of single family homes in different markets that are worth in that kind of price range. We have the we are syndicating. We do our land flipping. On the land flipping, we're already doing seller financing, so we're already having the benefits of that there. And so it's a very, very interesting thing, particularly for multifamily and for any kind of commercial property. So with that, thank you very much, Brett. That was great information. Thanks a lot, everyone, for watching this. This was another episode of the Forever Cash Life Real Estate Podcast. And coming up soon is another episode. So make sure you subscribe. Make sure if you're watching this on YouTube, you subscribe to our channel. If you're listening to this on iTunes, make sure you give us a 5-star review. You subscribe to our channel. Make that not the only, obviously listen to the other episodes. We have lots of great guests and solo episodes. So with that, having said, have a great, great day. And thank you, Brett.
Thanks, Jack.
Enjoyed this episode? Then make sure you like, subscribe, and post your comments and questions below the video. We're looking forward to hearing from you.